recording, and let's look at what we talked about last time, right? And what we're going to talk about today. Okay, so last time we were talking about the income producing property. We started the commercial part officially, which is a kind of a big one. So residential, commercial, and then the real estate based securities, right? The three important pillars. And then more importantly, well, not necessarily more importantly, but a higher risk and a higher scale of the kind of investment is the real estate development at the end. So in the property types, we talk about the residential part and all these, and we talk about why people use these and the different kind of characteristics that people are using. There are out there. Okay. So, and we talk about how important is leasing, because for most of the people, the leasing is a very important choice for them. It's actually their optimal choice. Okay, so we are going to start talking about things. Talk about the effective rent. We're going to start talking about things and starting in chapter 10 today. So the valuation part. Okay, because last time we couldn't pull it up online, so I feel like for this part at least, we should be able to look at the numbers on the slides and calculate it together will be a lot easier. So the valuation fundamentals. Okay, so the market is the most probable price given the following conditions. So we are basically saying that, of course, there are many buyers and sellers in the market. Okay, so there will be buyers and there will be sellers. And by the way, how many of you have taken microeconomics? Let me put out a poll. Have you taken microeconomics? Yes or no? Number 1 is yes. Number 2 is no. Three of you are not responding. Okay, so I assume most of you have taken microeconomics. And so what does microeconomics say? Well, we have demand, we have supply, right? So the supply is the sell side, the demand is the buy side. And all the demand part, they don't all supply, they're not all willing to pay the same price. So that's the thing. Like a lot of times you go into the street and you talk to your friends, and people are saying, "Hey, I'm not gonna pay that high price for that." But if he himself or she herself are not going to pay that price, does not mean that that good is not gonna be sold. That makes sense. So it will be sold because there are people out there who are willing to pay that price. So not everybody agree on the same price. However, the market will automatically determine the price. Remember the demand supply curve, right? The huge X. So here, if we want to look at the valuation, basically we want to figure out what is the proper price. So the fundamental question here is, what is the proper price for this property? Sorry, I'm trying to use my mouse to draw this thing, and it looks horrible. But the price is eventually determined by the demand and the supply, right? So the demand, last time we talked about what was the for the demand part, we talked about last time what was the for the supply part, we were talking about the market inventory. For the demand part, we were talking about the vacancy rate and the rent, right? So the rent itself or the lease price itself is the price. But here, when we're talking about valuation, we are really talking about the whole project. We're no longer taking the rent or lease as its price anymore. So namely, the goods to be sold is not the space per square feet anymore. We're really trying to see that we're really trying to look at the buying and selling of all these properties. Okay, so what do we assume? We assume that the buyer and sellers are typically motivated. Okay, we're not assuming that, oh, they're exuberant about it. It was, okay, wow, this one is a historical mansion here, turn it into an office, and I definitely have to buy it. No, that's not going to be a correct price for the evaluation. Okay, so we're assuming they are typically motivated buyer and seller, and both parties are well informed. Oops. So we assume that both parties are well informed. How do I make a highlighter? Oh, maybe it's better just to circle it better. They're well advised and acting in their best interest. So we can't assume that people are foolish. I mean, there are probably less than well-informed people who are kind of irrational, but as a correct starting point for valuation. Okay, so we're not talking about eventually nobody's had those behavioral issue or psychological issue. I'm not saying that, but if we're talking about some transaction that is at this scale and typically handled by a team, and you have agents working with you, we assume that both parties are actually well informed and well advised. Okay. And it is a reasonable time in the market. It's not like, say, Christmas Eve. You know, it's not some crazy time that nobody is trading, so the price is super low, or it's not like the really hot time right before the starting of school year. You know, everybody have to get into that exact space, exactly at that time. So we're talking about an average reasonable time in the market, and payment in cash or its equivalent. Okay, so we're just taking on traditional financing. So if you look at all these conditions, typical, well advised, well informed, reasonable, payment in cash and equivalents, and traditional. Look at all these words. It basically says that we don't want to consider these factors right now. Okay, because all of these factors could eventually come in and affect the price. And at this level, when we are trying to talk about the valuation structure as a starting point, we are not in a position to really consider in these factors, because these factors are secondary factors that are going to fine-tune the valuation at a later stage. So once you realize that, you understand how to do the whole process, right? So you start from the whole rational, reasonable, typical, traditional approach. And that's what we are talking about right now. And then later on, I'm not saying that you cannot include some buyer and seller who are atypically somehow really motivated or really not motivated, or some parties are not well informed, and so on and so forth. And if you count in those into the formula, then you're going to get a more accurate valuation. So then you have this appraisal process, just like a residential appraisal part. The appraisal process is performed by appraisers and others seeking to establish value. So basically, they're trying to give you a more or less objective evaluation of the whole property, and that's called the appraisal. That includes the physical and legal identification. So that will typically say, hey, here's the survey of the property. It will include this area, include this is easement and then that, and what part of it is belong to where, all sorts of things will be really labeled out on that. So that will be a survey. Okay, then we have to identify the property rights to be evaluated. Remember, we have many different kinds of property rights, although we don't typically consider all types of them, but we do have many types of property rights, right? So you could have, for example, a typical fee simple estate. You could have a estate in the future, all sorts of different kind of collateral rights and things. So you need to really identify exactly what kind of rights you are going to be evaluated. Specify the purpose of the appraisal. Okay, so that's also important. Are you providing the appraisal to give a second opinion or first opinion for somebody to be used for their mortgage documentation, or to help people determine their somewhere during their negotiation process of buy and sell? So you will want to, if you're an appraiser, you will want to mention that. Okay, specify the date of the estimate. That's also important. Of course, the date is oftentimes linked to value, and if you appraise the whole property, say 10 months later, maybe something's already broken, right? So it will be a different value. And then you look at the market data, you are going to apply the techniques, and we are going to talk about these techniques to estimate the value today. So just like a residential, 3 major approaches: sales comp, income approach, income capitalization approach, and cost approach. Okay, so again, for the residential part, sales comp is the number 1. In the commercial part, because everybody's using, well, not everybody, but most of the people are using it for leasing purpose and rental purposes. So income approach is getting more popular. And the third part is the cost approach. Okay. So we're going to focus here on the income approach, and the sales comp approach is similar. Just you use the data from recently sold comps to drive a subject market to get a subjective market value. So you are going to adjust this comparable sales price. So first dig up a comp, then you take that comparable sales price, which is per square feet, okay, per unit area, unit space, for its feature, age, size differences, etc. Then you are going to take all the adjustments and the square footage adjustments, and then you are going to get the final. So if you're talking about residential, then these sales comparisons, these sales comps are a lot more easier to get, right? So because you typically have in most of the area, buy and sells quite often. So within the neighborhood, or within the zip code, at least, you're going to have recent sales, and you can use those numbers. But For the commercial, it's not necessarily true. Okay, so for smaller size ones, maybe true, but the bigger the property gets, the less of a sales comp you can get. So it is less. If you have less comps available, then you have to search for further away comps or more historical, further back in the record. And the adjustment you have to do is a lot more. If you have to do more adjustments, that means you are typically going to have more error, right? Because all these adjustments are kind of like on the subjective side. So the more subjective things you're doing, then the more error you will make. That's why here we most likely are going to use the income approach. So within this income approach, we again have three different types. We're going to have GIM, the gross income multipliers. We have direct cap, okay, capitalization method. We have a discount present value method, is kind of NPV math method we talk about. So we talk about the gross income multipliers. So what is the gross income here? Anybody? What is the gross income I'm talking about here? Income before taxes. Okay, maybe it helps for us to get back. Yeah, probably most likely the rent. But let's look back to the handout that we had last time. Remember? Remember we had three handouts in the textbook. We had the waterfall court apartments. We have pro forma statement of cash flow for base year estimates, the Shady Elm Community Shopping Center. We have the waterfall, that one is that one. And we have the Webster Office Plaza, right? So, okay. So what do we see? If we're looking at the Webster Office Plaza on page 281, everybody have that? Can everyone confirm that you all have that? Okay. Okay. Yeah, so we have the revenue, which is the gross rent. And then we are going to take away from that the retail services. Oh, we add into it the retail services and cell tower, rent, storage fees, parking, and then we less the vacancy, we less the concession. So on top of everything, we get to the effective gross income, right? So that is for the office plaza. Then we have for the shopping center, we also have a similar structure. We have the base rent plus a bunch of other income minus vacancy and concessions. So that will also give us effective gross income. For the apartments, well, that's a distribution facility. Then they have less of other income from services and parking, but they do have a pass-through of property tax and insurance, so that they get back from the tenants. Right. Apartments also have vacancy and collection laws, concession adjustments and all that. So you do have to adjust certain things on top of the rent. That's the point, right? So you do have to adjust the certain things before any operating expenses happens, but adding on to any part that happens during the collection part. So if there are certain rent that you routinely giving out a discount and you cannot collect it, that will be a part of it. If there are part of the routine kind of additional income coming from, say, parking fees, other services, then you will need to count in it. Okay, so anything that happens in the collection part, then that will be your gross income. So if we look at, assuming we know what the gross income is properly, and if we look at this example, then the multiplier is nothing more than the sales price divided by the gross income, right? So we have 0.6 million divided by 0.1 million is the gross income multiplier, GIM, then it is 6 times. If we have 750 divided by 128, then it's 5.86 times. If it's 450 divided by 74, then it's 6.08 times. Okay, welcome, William. So then we have all of these numbers, and these are for the recent sales of a similar property. Then what are you going to use for the subject property? GIM uses a projection of growth over time, like the growth rate in fixed income instruments. Not really. GIM is actually even simpler. So basically saying that, assuming that you're going to have a stable gross income, and for that amount of income, without looking at the operational cost, for that amount of income, how much will it be worth? That's how I understand it. Say, okay, just like for a stock, yeah, so used for pricing, exactly. So here in this chapter, we are all talking about pricing. We're talking about the price of the property. We're not trying to lease out the property. We're trying to sell the property. Yes, we're trying to get a price or the proper value of the whole property. So if we look at the recent sales, number 1, 2, 3, and which number should we use? One? Anybody else? Okay, so basically selecting which one is what it calls an education opinion. So that's actually a tricky question. So it really is not something that we can judge from the current information that we have, but instead we will have to look into which one is the most similar to the subject. Okay, in terms of market timing, in terms of the size, because sometimes a bigger size office space, for example, per unit square feet will be at a different scale compared to a smaller size office space. So how should they be weighted? Like some of them might be closer or more similar to the subject than the others. Then the one that are closer should then be priced a little bit higher, be weighted a little bit more important. Okay, so if suppose at the end the 6 times is determined to be the GIM, well, I'm not saying really that it should be. Jonathan asked a question, say, So based on variable conditions and highly subjective, yes, this is highly subjective. Yeah, because the structure itself is kind of too straightforward, too coarse, too crude. You kind of have to have a built-in piece that allows it to be a little bit floating. Okay, so, and there's always this question, even in the sales comp, in the recent sales comp, it's the same thing. How similar are these property, right? So are they in the same neighborhood or just in the same MLA or in the same zip code and everything? So here we're talking about, suppose we know that the 6 times is the proper GIM and the subject has a gross income of 120, okay, then what you need to do is simply multiply the 6 times to the 120 grand, and you are going to get the sales price or the value, and that should be 720. So that's why we call the 6 a multiplier, because you literally just multiply it onto the gross income. Make sense? Any question? Okay, then that is the first income approach, GIM. Now let's look at the second one. The second income method is called capitalization rate. Okay, so it's just so similar to multiplier. Now this time, instead of multiplying, you are dividing it by a capitalization rate. We call it cap rate for short. Okay, for short. So we call it the cap rate. Okay, so the net operating income is then, if we look at the 4 examples that we have last time. So we start from effective gross income, and we subtract from it all the operating expenses, and we subtract the improvement allowances or capital expenditure. So sometimes periodical capital expenditure to maintain the property is important, right? So once we have that, we get the net operating income. So basically, the net operating income is really like the regular stock market. If you have a financial statement, an income statement, you look at the bottom line is the net income, right? So here is the net operating income. The net income part in the company, also from that point on, it will have amortization, have tax, have all sorts of the interest payments and all that fancy stuff, right? So, but here when we are talking about real estate, we kind of mix that up because we typically don't have any intangible asset to really amortize over. And to simplify things, we just include the interest payment. Actually, I know in some area of the accounting practice, they also include the interest payment into the operating income. So here, because mortgage is a very mortgage and insurance is typically the important operating expenses. So I think the mortgage part is about how much money you are financing. So it's kind of where your source of financing is coming from. And that is not something that's really pertaining to this property management. So I guess that's why that mortgage payment or interest payment is excluded from the net operating income. But the insurance is necessary for the whole thing to be operation. So the insurance, property tax, management administration fee, leasing fee, maintenance, operation, utilities, cleaning, okay, and other taxes, and all the tax and fees and things, the regular things are included to get the operating income. So just want to clarify from that, net operating income is not exactly equal to the net income, but in a sense, it can be also thought of as the kind of profit that you're getting from the properties. That makes sense. So in accounting sense, there are lots of differences, but in essence, that's what people want to look at. Okay, so then instead of looking at a value equal to a multiplier times the times the net income or something, now we're looking at the value equal to the net operating income divided by the cap rate. Okay, so for example, we have recent sales price of 368,500 for a net operating income 50, assuming all these net operating income are provided and calculated correctly. Okay, and then we have the cap rate 13.57, 13.2, 13.77, 13.72. And which one shall we use? Well, all we know is the capitalization rate, the cap rate will be between the smallest of these and the biggest of these. Exactly which one should we use? Again, it will be a education opinion. It's about which exactly the property that you try to is similar to the subjective one, and questions like that. Okay, so of course, the higher the cap rate and the lower the value, given the same amount of net operating income in general. So now that you have the sense of it and see that the value of it is really equal to net operating income divided by the cap rate. And if I say the cap rate is equal to 13.5%, okay, and the net operating income is what, 4 million? How much is the sales price? I'm basically looking at the Webster Office Plaza here, and it's like a 3.9 million. Suppose it's 4 million and the cap rate is 13.5%. How much is the value of it? People, can you guys also share your videos? Yes? No? I guess nobody talks to me. 29.6? Good. Oh, camera not working. Got no power. Okay. I just feel like I'm the only face on the screen. 540. Okay. Okay, let's see what my is talking about. Yeah, 29.6. William, you will have to adjust that because it's really just 4 million divided by 13.5. It's not multiplied by 13.5%. So once you divide by 13.5%, it should really get bigger than 4 million, not less than 4 million. Okay. So for those of you who are very into this kind of cash flow, just like a traditional financial, this kind of cash flow kind of mindset, then what do you think? Remember, we have a discounted cash flow that has a discount rate, right? So that discount rate has a bunch of components in it. So say there will be the risk-free rate in it, will be inflation in it. On top of that is say liquidity premium, maturity premium, certain kind of, for any kind of risk, you are going to take a risk premium on top of that. So what do you think this capitalization rate contains? Risk exposure, yeah. Interest risk, okay. Anybody else? Okay, so suppose we're talking about an annuity. Okay, assuming that this property is able to generate this amount of net operating income every single period for indefinite amount of time. So, how much will that be? What's the value? How much is the value of that property? Suppose we're talking about, say, a perpetuity kind of structure. Everybody remember perpetuity as a form of annuity, remember? Yeah, so that is having, right? So that, what kind of example you can make for perpetuity? Usually, typically, the perpetuity that we say is more like a say preferred stock that's going to pay you a fixed dividend for indefinite amount of time, right? Remember, it's different from the bond because bond all have a maturity date, but the preferred stock can actually pay you dividend for indefinite amount of time. And then so also we can talk about certain kind of trust. If you have a trust or endowment, that kind of payment is also a perpetuity. So here, when we are evaluating using the cap rate, we're kind of making an analogy to those perpetuity and assume that this property can generate all these net operating income for indefinite amount of time. Okay, so for the perpetuity, do you remember the pricing formula? The price is really equal to payment divided by the interest rate or discount rate. And that discount rate will include all the risk exposures that you have, right? So here, we just assume that this net operating income is going to be the payment that you are going to get. And that's why we try our best in trying to exclude or set aside capital expenditure, tax, and all the regular expenses and make sure this is really a net figure that you are going to get. And towards the end, and also we want to count in all the risk that's going to be involved on top of all these payments. Okay, so once you put that in, we have this value. So as you can see, we really are making an analogy and really calling this property like a cash cow. Okay, say, okay, this property, if we maintain it well, it will give us the net operating income indefinitely. Not like just for 30 years, not like for 40 years, but you know, for forever. So that's the latent and not spoken implicit assumptions behind it. Okay, so we understand that the higher cap rate, the lower the value. So if we look at that, the value of it should be really between the same net operating income divided by the highest cap rate and the same amount of income divided by the lowest cap rate. So notice that this one's got a lowest cap rate, but it's got the highest value. This one's got highest cap rate, but lowest value. Okay, so exactly what are you going to be using for R, the cap rate? And you're going to be very careful. You're going to be very careful. Okay, so then how exactly are you going to determine it? Well, consider first of all how similarly it is to the subject. Well, consider the following: the physical attributes, the location of it. Okay, a lot of times if you go to a real estate agent or any people who are helping you buy and sell a property, you tell them, hey, what should I consider? They'll tell you, oh, there are 3 factors: location, location, location. Well, yeah, it's kind of true for a layperson, but location is definitely of paramount importance, but doesn't say that that's the only factor you should looking at, right? So we should be also looking at the lease terms. Are they offering the same favorable kind of lease? Okay, the operating efficiency. Okay, so here, if we consider the comparables, okay, first of all, if we look at the statements, some of them are stabilized. What is stabilized net operating income? Anybody understand? Okay, so as we said, that the net operating income should take away all the operating expenses, but some of the operating expenses or capital expenditures are arguably actually non-recurring. That makes sense. So sometimes you have, yeah, I have a major repair. Okay, I have to do a foundation fix. Well, yeah, that is going to be a huge outlay, but is that going to happen like every 5-10 years? Probably not. If we fix it, it will be fixed forever. Okay, so you want to look into the statements just like these in the handouts, but in reality, it will be a lot more complicated, of course. And then, excuse me, and then if you see anything that's non-recurring, if it's a lump sum, okay, if it's a lump sum or it is averaged over the time, are you going to, maybe you want to consider taking it out of the net income, net operating income? I mean, really adding it back if there's any expense that's non-recurring, maybe we add it back. If there's any income that's non-recurring, then we are going to subtract it. Does that make sense? So again, this will be another subjective adjustment process, trying to make the net income, net operating income, really closer to the long and infinite flow of cash flow that you're gonna get once you get your hands on to this property. Does that make sense? So basically assuming that coming back to the assumption, this one, okay, so the assumption is that you're going to get an infinite stream of the same net operating income with some kind of reasonable fluctuation that's discounted in there, okay, but mostly the same. So you want the net operating income really to be representative of the following years. And that's why you want to take out any non-recurring ones, okay? It's not going to be periodical. And to make sure that these one-time outlay or one-time payment or one-time income are not going to actually skew or somehow mess up your net operating income. Okay. So depending on the analyst, leasing commissions, tenant improvements, and recurring capital outlays may or may not be including in the calculation of net operating income. Okay, so that's just a caveat to make sure that the net operating income is really of the highest quality. And then depending on the similarity, you are going to also determine the cap rate R, and then you are going to put everything into this super simple formula. So I don't know if you have ever discovered this kind of a general rule in finance. The more simple the structure looks like this one is a super simple structure, right? So with the net operating income, cap rate, that's it. And same thing in the previous one, the gross income times a multiplier, that's it. Okay, so the simpler it is, the more care you have to go into each of these numbers. Make sense? It's just like a Gordon growth model, super simple, right? But the real difficult part is what's the growth rate? What's the projection? What is the R, right? So all those numbers are going to be harder and messier to determine. Okay, so now we have the first and second income method. The first method basically says that we take the gross income and compare it to the sales price and see what's the ratio between the sales price and gross income. Okay, so sales price to gross income, to the ratio. Then from the subject's gross income to get to the subject's sales price. And for the second method, the cap rate method, then we take the value or the price, sales price, and take that as this net operating income divided by the cap rate. Hey, you're like, wait a second, right? So if we look at this whole rate as a whole, then isn't that, and just do a simple mathematical manipulation, isn't that this 1 divided by R is equal to the value divided by the net operating income, right? Can everybody see that? Right, so in this case, instead of net operating income, instead of a gross income, we are looking at net operating income, NOI. Instead of the sales price, we're looking at the value, right? So if we assume the value and price are interchangeable, and the only difference we are looking at is really that we replaced this this gross income by NOI. So instead of using gross income, we're using NOI and assume there's another multiplier, and that multiplier is more like a reciprocal of the cap rate. Okay, I made it sound complicated, but really the question boils down to when do you want to use NOI and when do you want to use gross income? Okay, let me put out a poll and say that choice 1, you like the gross income better. Choice 2, you like NOI better. And choice 3, you like both. And you think you should always use both. Which one do you like? So far, nobody choose one, huh? Omar, what do you choose? It may depend on one's net operating income. Yeah, it really is a question that depends on what's the situation and how are you going to judge the situation. Your judgment will be based on which one is more stable and which one will be more relevant, right? So when we're trying to use the data, especially if we're trying to use the one-shot data to represent a stream in the future, we want that representative to be a really good one and to be really a relevant one, right? So for the gross income, it includes everything you are able to receive, and net operating income will also look at everything you're going to expend. So for the cases when the operating expense part is really messy and cyclical and not doing very well, erratic and disrupted expenses, and maybe change of the management and fees everywhere, and it's not very proportional to the size, then maybe you want to come back and look at just the gross income. But on the other hand, if you have that kind of operating expenses, existing operating expenses, you might want to consider coming in with and replace some of the operating practice that it has currently, right? So really, it comes back to the two questions. One is gross income more stable and more meaningful, or actually, should I phrase the question as which one or between NOI and gross income is more stable and more meaningful? And second of all, can I provide a different and cheaper operation practice? So if I can say I'm Warren Buffett, right? So I come into this company, and I really don't care how efficient is the company's operating margin on everything, because I'll be able to replace and have my people. I'll be able to. Well, I'm not saying he regularly do that. In fact, he probably just do the opposite of that and just go talk to people. And if the management doesn't work, he won't even buy the company. I'm just saying that if you're in a position, that you have part of your business as management consultant, you'll be able to come in and do a few things, kick out some people who are not actually working, and make sure everything is operating in a much better, smoother ground. And in fact, that's what you are planning to do. Then you should be actually better off looking at the gross income, because that will be the part that's receiving. You're gonna come getting the receiving end. Okay, so you kind of don't care how irregular is the expense part. On the other hand, if you're coming in just as an investor, you're gonna take everything as is, the current tenants, current management, and everything. Then look at NOI. Definitely look at NOI. Okay. So let's take a break of 10 minutes, and we'll come back. And look at the third method and start the next chapter. Okay. See you.